This is episode 4 of the Bitcoin price report for October 18th, where we discuss the macro, the micro, fundamentals, and technical analysis with a focus on the Bitcoin price. Today, Bitcoin was at 19,563, up 2.4% from last week. We're still consolidating around the very firm support level at around 18,550. The CBBI.info index is at 7 in the undervalued range. Our dollar cost average and limit order strategy portfolio remains unchanged and is down 0.03% from inception. Let's move on to technicals of the markets. The S&P 500 has rebounded above support levels of 3650. The Nasdaq QQQ is above support levels of 11,030. The 10-year yield continues to rise, so bonds continue to fall in price. Gold remains below resistance at 1680. Oil is below resistance as the US continues to release strategic reserves before the elections. The dollar remains flat. The pound has rebounded and is now near resistance of 1.14 after the finance minister stepped down and tax and fiscal policies were reversed. The euro is consolidating, while the yen is continuing to depreciate now above 149 yen to the dollar despite BOJ intervention. So far we covered support and resistance and technical analysis. This week I wanted to go over a really good technical indicator called the MACD, or the Moving Average Convergence Divergence Indicator. This is one of the first indicators you learn in technical analysis. It takes the difference between a long-term moving average and a medium-term moving average to measure momentum and changes in momentum. A moving average of the MACD is called the signal line, as you can see here at the bottom, red. And whenever the MACD, in white here at the bottom, crosses the signal line, it signals a change in direction of prices. For bear markets, we can use the MACD slightly differently to capture reversals. Once we see a turn in the MACD, we can consider a change in momentum even before a crossover. Here we see the purple arrows that indicate reversals. So we can use this for any market, but let's look at the monthly charts on the S&P 500 during bear markets. You can see in 2000, 2008, this indicator was effective. Gave a couple false signals in 2000, but still did a fairly good job with signals near the bottom. Prices likely have to rise 15 to 20% off the lows for reversal signals. So we can't catch the very lows, but for multi-year portfolio allocation, this is a great timing tool for long-term trends. Here we have good signals in the 70s for the bear market recessions. And from 1929 to 1942, we had some serious bear markets and recessions in the Dow Industrials. And we can see that there were some good reversal signals as well. So this can be a powerful tool for timing. Here in 2022, we don't know what's going to happen, but it's good to be patient and just wait before we see the MACD reversal. We're not going to hit the exact bottom, but it'll be good enough to give us a longer term trend for the next 2, 5, 10 years. So if you like this info, please like, subscribe, and share, and we'll continue to update you on MACD signals for a variety of different markets. So let's go on to some macro perspectives. There was a very good interview with market strategist and historian Russell Napier, who gave his perspective on financial repression for the next 15-20 years. Financial repression is when governments intervene in the economy to implement policies to reduce their debt burdens. This includes advocating for interest rate controls, directing credit to certain industries, and a greater influence on money creation. The debt to GDP, both the public and private sector, is very high in the US, France, and most developed countries. Hence, the most likely way out of the debt is increasing nominal GDP, which means inflation. Currently, commercial banks control money creation in our debt-based money system. The trend is that the governments are taking control of money creation through credit guarantees on bank loans, and governments are beginning to direct investment into preferred policies such as energy, climate change, or any government initiative, and this is the politicization of credit. In Germany, 40% of new loans are guaranteed by the government, 70% of loans in France, 100% in Italy. Remember, when commercial banks create debt, that's creating money. So now companies get easy money in certain industries and are likely to take more risk. And banks as well, they'll freely lend out high risk loans with these government guarantees. Usually that doesn't end well. Governments also need to force institutions to buy bonds through regulations, such as already done with insurance companies and pension funds. We'll see if this continues, especially with pension funds already struggling. Lastly, the central bank can buy bonds, which we call yield curve control, to manage long-term interest rates if investors start to demand higher interest rates. Napier sees long-term inflation from 4 to 6% and stagflation happening many years later. He foresees a home-shoring boom whereby money is directed towards re-industrialization and a capex boom. A lot of good thoughts, and you can check out his article below. You should also follow Lynn Alden, who gave her monthly update last week. She discussed the sovereign debt crisis and how we went from 18 trillion of negative yielding bonds in 2020 to high inflation and high interest rates. It's hard to believe investors were buying bonds with expectations of negative returns over the life of the bond when interest rates were so low. And now those bonds and investors who bought them have been crushed. So hopefully investors learn better to have some common sense and not buy assets that effectively yield nothing. Lynn has probably one of the best perspectives of our current economy in the context of long-term historical trends of monetary and fiscal policy, especially her insights on the similarities of our economy with the 30s and 40s. I highly recommend her article titled "A Century of Fiscal and Monetary Policy, Inflation versus Deflation." She wrote in late 2020. That puts much of what we see today in some good context. Here's a liquidity chart that shows a 115 billion increase, and Max Anderson, based on this data, has a target of 3850 for the S&P 500. Macro Charts has a good chart that shows that trader capitulation likely has not occurred. It happens when traders place more puts than call options, and we're not quite there yet. And that's all for this week. Please like and subscribe, and see you next week. Thank you.